Hello, and thank you for joining us on the Optimal Wealth Podcast, where we discuss creating passive income through real estate. Our mission is to help educate investors on how to grow wealth and invest passively. My name is Jared Alexander, and I am a passive investor, currently in 6 syndications as a limited partner. I am also the founder of Optimal Equity Group, which is a real estate investment firm that was created primarily to help educate the passive investor. We do that in a couple of different ways. One is we provide education to help give you the confidence to get into the passive investing space. And two, each episode we will interview amazing guests that explore the strategies, insights, and secrets used by successful investors. Whether you're a seasoned investor or just starting out on your real estate journey, this podcast is designed to help give you the confidence and knowledge you need to make informed and profitable decisions. Welcome to another show of the Optimal Wealth Podcast. And today we have our guest, Craig, my brother. Craig, welcome to the show.
Thank you so much for having me. Pleasure to connect with you today.
Yeah, absolutely, man. And Craig and I met probably what is it, a few months ago now, at a little event mixer, what we call it, at his house there, and got to know Craig a little bit more. But I'm honestly, Craig, we haven't really sat down and had that long of a conversation. So I'm interested in kind of getting into your story, how you got into real estate, and kind of what got you into the multifamily space and working with Lone Star Capital. So before we do that, though, let me go ahead and I'm going to read your little quick bio here for you. So Craig is the director of business development at Lone Star Capital, which has acquired over 350 million of multifamily real estate. And I think we're probably about 500 million now, right, Craig, on that?
Yes, sir. We're about a half a billion, so that needs to get updated.
Yep,
hmm
definitely. And has a passion for sharing his enthusiasm for multifamily investing and serving Lone Star's investors. Prior to joining Lone Star Capital, Craig spent 7 years in the real estate sales industry and sold over 100 homes. He graduated from the University of Arizona with a degree in urban and regional development. So yeah, quite. So it's definitely got some history in real estate there, Craig. So I'm gonna kick it over to you, and if you could just walk us through that journey and how you got to where you're at today.
Yeah, absolutely. Well, thank you so much for the background and having me on the show today. Basically, I came out of the womb wanting to sell real estate when I was a kid. I was watching ESPN, Sports Center, that, and then also I was watching HGTV and flipping shows. So I always thought, perfect, why would I just sell houses? So graduated college, got my real estate license for California, and I thought I wanted to sell houses for forever. Then I realized, well, I didn't love the Bay Area long term. I didn't feel like this is the place I wanted to be forever. And then I moved to Phoenix, Arizona, which is where we met, of course, at my house, and started selling real estate here. And then one day I got beaten up over about a $500 transaction dispute on a deal. And then that same day I called Rob. Rob and I became very good friends over a couple of year period at this point, and he was telling me about he was getting beaten up for a $50,000 dispute on just with a partnership kind of setting up. I'm like, okay, well, I want that problem. So I kind of, put my feelers out with him saying, hey, if there's ever a position where the firm's looking to expand and needs a more formal salesperson, please let me know because I'd love to potentially see what that would look like if there's some mutual interest. Sure enough, there was some mutual interest. That's what got me in from the single family home sales background into the multifamily kind of private equity space. So it was very organic and fortunate. If I didn't have such an incredible mentor and friend and Rob, I don't think I'd be in this space now, but I'm very grateful for the knowledge, the insights, and the career trajectory that kind of transfer has made for me as we are today. So was selling homes for about 7, 8 years, and then switched over to raising equity and the director of the business development, which is basically relationship building, relationship preservation, and all things kind of equity side for the firm.
A lot to unpack there. And I like how you talked about, ESPN and then HGTV. I think you and I are similar in a lot of ways. I love sports, but growing up, my family was in real estate as well, right? And I just kind of had that knack for just being involved in what they were doing and the single family homes and stuff they owned and fixed up, as far as my mom and my grandfather there. So can definitely relate to you on that aspect. And so I think one thing to point out is just, the power of, and you come from a sales background, right? With being a realtor and selling homes, but just the power of, reaching out, networking and putting yourself out there and, reaching out to an old friend like Rob puts you in a position now to, now you're not doing single family homes no more. You're on a much larger scale. Craig and I and Lone Star have had the opportunity to partner on a few deals. And the last transaction I know was what 105 million, right?
Yes, sir.
Across three properties there. So tell us why not? Did you ever buy single family and invest in it, personally, or tell us a little bit about that?
Yeah, absolutely. So I bought my primary residence, was the first house that I acquired, which is the house that you visited me at, of course.
Okay.
And I still want to own a fair bit of single family homes just for the diversification play and also my insights of being a real estate agent. So I'm very open-minded to doing that. But the unfortunate reality that you learn in the single family space is the lack of scalability you'll get on the cash flow perspective and operations. So first off, when it comes to single family homes as opposed to multifamily, naturally they're spread out, so it's less scalable. But on top of that, one little miscellaneous thing like a roof kind of, coming out, or, being an issue, or fixing a dishwasher or a pool pump or something of that nature could come up. That could be a couple $1,000. That really does eat up your year one initial cash flow, as opposed to in the multifamily space, especially in the syndication space we play in. You're, already kind of baking in capex improvements and, lift associated items in the budget on the front end that should kind of take up this situation and process where all the free cash flow should be eaten up. So there's just, typically speaking, more cash on cash return to be created there. And also, you can force a little bit more appreciation, it seems, in the multifamily space, as opposed to the single family space. Plus, the scalability is really attractive, especially when you figure out and build up partnerships like we have at Lone Star. So it's a little bit harder to scale a business in the single family space from the investment side, I believe, as opposed to the multifamily space. And I learned this in real time. Through buying my house, I've learned that, hey, you have a potential issue of things that are going to come up. And although I will be buying more houses in the future, I think the multifamily space, typically speaking, is a better vehicle for investment and for, equity growth and multiplication.
Yeah, no, definitely. I agree 100%. And, and I bought my first single family out of state. And the goal was I was just going to buy 60, 70 houses, right? I wanted to just replace my
Hard to
W-2
scale.
income. It really is. And
Yeah.
I did that first, and first purchase, and I'm like, oh my goodness, I got to do this 60 more times, right? Which I was still willing to do. I mean, I'm determined. But then, like you said, 3 weeks after that, I got my first bill, and it was a sump pump repair, right? Which I had no idea it was an out-of-state rental, didn't even factor in a sump pump. And $4,000 later, I just wiped out my cash flow for 2 years, right?
What, and on top of that as well, to think about is this: every micro place you go to invest in. So let's say if you're investing in the Midwest or investing in the East Coast or, the Florida or Texas area, right? Or Arizona or wherever it may be, every single geographical location will come with its own nest of issues. So Arizona will have its own nest of issues, Texas will, whatever it may be. The issue is if you invest out of state is, and especially if you're, geographically diverse in different areas, you're going to learn the hard way what those are every single time you go through the property. And an inspection report can be helpful, but the reality is that once you own the property and you have your tenant in there and they're renting it, the problems will really start to come out as opposed to, what was disclosed in that selling process and that inspection process when someone kind of briefly goes through for, a couple hour process.
Yeah, absolutely. Yeah, you can underwrite as much as you can think of, but you just like you said, you never know what's going to come out, after that initial inspection or like again, just who thinks about a sump pump? Like we don't have those out here in Arizona, right? We're both here in Phoenix, and you just yeah, you don't think about. But the other thing to that is what you mentioned about scalability, right? Is and then let's just even talk about a one unit to say a 14 unit or a 50 unit, right? I mean, you're still doing pretty much the same amount of work as far as underwriting the property, acquiring it, inspection. Now it's a much higher dollar amount, and you want to definitely make sure you dot your I's and cross your T's because, one mistake can really be costly. But, as long as you do all that, I mean, and getting that to the finish line, it's the same amount of work. You get a property manager in there, you manage the property, but you got instead of one single family unit, one tenant paying rent, that asset spread across, between 14 to 50 people paying rent, which I believe is more risk mitigated, right?
Well, especially, when you've got, only one tenant, well, when your tenant moves out, you have a month-long process to replace it. But if you've got 10 doors and, you've got 9 people renting there, it will feel less impacted, that one tenant moving out as opposed to, the one, if it's your only tenant moving out, has a way bigger impact than, one of 10. So, you can absorb that loss there and that turnover process. So it's a little bit more dynamic in that regard.
Yep. No, definitely. Well, and so I think that's a good transition into, so now, come out of the realtor space, you're working with Lone Star Capital. Let's dive into a little bit of, I think let's talk about the market, what are y'all doing to mitigate risk and with the high interest rates and what are y'all foreseeing? I know I just asked about 3 or 4 questions. We could probably spend a podcast on each of those just alone.
Absolutely.
If you could kind of condense that a little bit and just kind of tell us where you're at and what Lone Star is doing today.
Yeah, well, we're really excited. We have two strategies for our acquisitions. So as you know, we've got our market rate deals, which are just normal down the fairway, value add multifamily plans, buying, kind of A minus to, B minus deals. 80s or newer, ideally is 90s and 2000s, but we will do 80s for sure, with some sort of value add play. So we have that side, and then the other side that we also work with, which is a little more unique that Lone Star Capital does, which is the affordable plays, where we utilize some sort of a tax payment or some sort of credit that makes the deal unique and gives us a little bit of investment alpha. With some nuance and complexity to it. So those kind of the two things that we're doing, looking to buy, deals in that 15 to $50 million range, typically speaking. Hold it for about 3 to 5 years is the plan. So that's kind of what we're up to right now. And not much has changed there. Looking for, a really solid and handsome return, above obviously market beta naturally with the forced appreciation, with the value add improvements. But what we're seeing right now is actually cap rates widen a very healthy amount. So leverage has actually gotten a lot more attractive because we're going in with fixed rate agency debt. So that will accommodate a 5 year, hold structure, 5 to 7 years. Maybe we'll sell it before if the capital market will prevail and things look solid. But we're looking to hold deals for, call it 4 to 6 years, typically speaking. Maybe exit the deal a little bit early. But with leverage being better right now, with cap rates widening and interest rates actually starting to go down a bit, there's a really nice kind of play right now where we're seeing deals that are really penciling out and making sense. Even if rents stay pretty soft, that we're excited about them. So we're finally seeing the dam break a bit and yields expand a bit. So that's really exciting and encouraging to see. The cash on cash has really increased over the last, I would say, year. Over 200 points, I would say, just on going in, and then cap rates have expanded a good amount. So it's obviously scary if you've got any bridge debt or floating rate debt, coming up here in 2024 and 2025. There's no doubt, or if you're in your extension period right now. Fortunately, we have very few properties with that debt profile and structure, and the deals that we do have there are very well stabilized and shouldn't experience any capital calls. So we're excited about that, and we're just ready to play offense in a trying time.
So real quick, I'm glad you brought that up, the bridge loan versus the fixed rate debt, because like you said, a lot of these, I mean, I think I just heard a number over $1 trillion coming due just in 2024, right? Of a bridge loan debt, which is just floating rate debt. So a lot of these operators, got a three year debt and hopefully by the interest rate cap, right? If they didn't, they're probably really in trouble. But now, these 2021 deals, early 2022, they're going to be coming due here next year. And so, if they didn't buy a rate cap, again, they're gonna be paying a price here. But even the guys that did buy a rate cap, I mean, and are performing their business plan and executing it just as planned, are still in trouble, right, Craig? I mean, you've probably seen these on a few properties. And so I want to talk about that difference and again the risk mitigation, because as an investor, as a passive investor, I want to house my money. I want to, get the best returns for my money while mitigating, minimal risk, right? Investing in an asset that's gonna have, um I want to invest in an asset where I'm not going to lose my money, just to sum it up, right? So how
Yeah.
are, so yeah, touch on that a little bit between that and the fixed rate debt.
Well, the sad thing is that most people don't look at the debt profile. They don't look at anything but one number. That number, of course, is the projected equity multiple and IRR. And unfortunately, you can really skew those numbers with your projections and inputs and whatnot. We are very conservative on our projections, so sometimes we actually lose the potential of an investor due to the fact that we are not the most aggressive when it comes to projections. We'd rather come in really close into what we think it's going to be, or even maybe downplay what we think the deal is going to do to best impress and earn the trust and respect of our investors over a long period of time. So unfortunately, a lot of investors are frankly blind to risk. And what's going to have be an issue is that the shorter your debt period is, the riskier the investment is just inherently going to be. And that bridge loan and that floating rate debt deals that a lot of people are doing in 2021 and 2022 that vested that are going to be the problem children are deals that were likely with a 2 or 3 year debt profile. And unfortunately, coming up now in 2024 and 2025 is just going to be simply the cap rate market is too wide for where they're going in cap was and what their exit is. Therefore, there's been a lot of equity evaporation. So effectively, those deals are riskier in nature due to the short term debt profile in them. So they have to exit in a market or refinance in a market where the deals have kind of gone down in value. So the basically the longer the debt period, the safer the deal is. Then the safest structure you could have on a deal that might have slightly lower IRR is likely that 10-year, fixed rate debt period that would, have a longer tarmac because you'd have to think, hey, in 10 years, you're going to increase the yield on the property, you're going to increase the rents, you're going to stabilize the property, you're going to do a lot of improvements. And then it's safe to say and assume that in a 10-year cycle and period, that there's going to be a very green pasture to exit the deal and sell from where, you should get a favorable enough cap rate where you could leave the property over that course of time and make some good investor money.
Yeah. No, I like that. As I'm thinking, like kind of have what I just said is, yeah, I definitely want the best return, but I'm okay with a little less return and not, doubling or 2.5x in my money. If I know in 3 to 5 years, hey, I'm gonna get what's projected, maybe a little bit more, than what we're, projected on the business plan there or the pro forma. But I'm okay with the doubles or a triple,
Yeah.
right?
I'll take a single. I just don't want to lose money. And to
Right.
your point, yeah, what you want to focus in on, if that's what you're seeking, is the tarmac of the deal. How long are you going to invest in it for? Is it 5 years? Is it 7 year with the debt structure? What are the rent assumptions and components there, as opposed to what yard your co-star is going to stay, and then the business plan and also the leverage point. Usually if you want to be a little safer, max out, make sure that your DSCR, your debt coverage servicing ratio, is above that 1.25 threshold. Those are the key metrics you really want to hone in on and focus in on if you're, looking for a safer return profile.
Yeah. Yeah. No, absolutely. Well, and I'll tell you, as as coming from a passive investor here, kind of from that perspective, when I'm looking at investing with an operator, right? Of course, you always hear the know, like, and trust. And I've had the opportunity to work with Lone Star and their team, and I just gotta say they're awesome to work with. You look for the communication, they have the experience, they have the track record. You heard Craig talk a little bit about that earlier on, and now they're up to what, $500 million under asset management. The creative financing or the creative deals that they're coming up with using these tax abatement strategies, like on that three property portfolio. We just saw y'all implement that, and which was a process, right? But it
Yes.
with that, but got it to the finish line, and which is huge, especially in Texas. And I know that, some good cash on cash return there. But I like how with Lone Star Capital, right? I think it's important to really look at, and Craig, I want you to touch on this a little bit. Is of course, yeah, no like and trust, communication is great, but let's go into the underwriting model because I think that's where y'all really stand out as well. And then, like we were just talking about, kind of the little lower projections. But let's talk about Rob and his experience. Just the books he's written, and let's kind of go down that road a little bit. If you could just touch on that for us.
Yeah. Well, effectively, Rob has published two books that have sold over 20,000 copies. So, in a niche space, it's quite a large amount of copies for books. The definitive guide to multifamily underwriting, and the other book was structuring debt and equity for multifamily real estate, or just for real estate. So, two great and impactful books that are super crucial for the industry and the firm, and for educational purposes. Recommend you to pull those up and to acquire them if you're looking to learn more about investing. If you're an LP, or if you're trying to become a sponsor, recommend both. But Rob effectively has also created an underwriting model that's proprietary, that is open for the public. So it's kind of his model that he created, that he thought was helpful for kind of underwriting deals that are likely in that 100 plus unit space. If it's below 100 units, it's not as applicable and tangible for your specific underwriting, but really helps us have a slight cut above and understanding with our proprietary information that we've created, that we've allowed for people to use as well. But we're really confident in our underwriting projections, and it's something that we're only getting better at. And also for our purposes of reporting and investment and asset management, it's really important that we track our information and data super well. Our underwriting helps us do that. So it's a really robust system with our reporting. And on the trust side, for the no like trust, it's probably an easier process to start the trusting side with us, due to the nature of effectively how we report and implement our information, and are so transparent through the investment hold process as well.
Yeah. Well, and I can definitely speak to that transparency because I mean, if anybody's interested, just go to, what is it, lscre dot
.com.
com, right?
Hmm.
And everything what Craig had just mentioned, it's all on there. I mean, anybody can go view it. You can spend literally hours just on the content, not even without buying the books or anything, just on the content they have there of what they do, how they underwrite these deals and their process with that. So thanks for touching on that, Craig, because I think that's super important. I mean, I again just going back to like you said, the trust factor. I'll tell you, as a passive investor and with Lone Star Capital, I get the updates too, right? So, whenever you are in a deal, you see the updates. I mean, again, very transparent. There's overload information, right? Just, I don't even have time to go through it and really look at everything that's in there, but it's everything's in there, right? So what you appreciate from the sponsor, I just want to know that, hey, they're doing a great job. They're communicating what they need to do. They're sending me the monthly updates, and most importantly, really is I'm getting a check, that monthly, right? Which what was promised, or not necessarily promised, I don't like to use that word, but what was projected in the business plan, right? Because just to clarify, nothing's guaranteed in this business. So but you definitely like to see people delivering on what they say they're going to do, which again, another shout out to Lone Star there. So Craig, let's talk about what you see, where you see the market in the next few years. I mean, do you see interest rates stabilizing a little bit, going down? If they are going down, do you have a percentage? And again, these are just crystal ball assumptions here, but just curious on what your thoughts are on everything.
Yeah, I definitely think there will be rate cuts coming into the election year of 2024. I feel certain. How much we don't know, when we don't know, but I do feel that is coming. So I feel pretty good about that. I do think though that you can't outrun the math and the numbers on this deal, or for a lot of deals. So there just will be a lot of distress due to so much debt, as you mentioned earlier, coming up. So inevitably that's going to be a problem for Many people who just bought at the wrong times of the cycle with the wrong debt structure. So there will be a lot of stress and great opportunity to buy. For those that can play offense here coming up and can raise money for deals and buy deals, you'll be very handsomely rewarded for your courage and your bravery to do so and your ability to do so. So we plan on just buying as much as possible. We've got a very stable portfolio. So, I'm sure that fundamentals will get a little softer, but rates will get cut soon and the economy will bounce back at some point. So I do think that transaction volume will also pick up soon as well as rates get more normalized or at least stabilized from, I think, a height perspective. Once rates are stable and kind of start going down is when transaction volume just starts to kind of pick up again. So I think the slowness of the market will be over in 2024, and I think 2024 and 2025 will be incredible opportunities to make some acquisitions and investments if you're a passive investor, and if you kind of been thinking about raising capital or kind of bundling up some money together. I definitely think 2024 and 2025 will be some incredible years to kind of get your ducks in a row to start doing that and making those moves if you're a capital raiser, or you're looking to get into buying properties. I think these are great years to come up from a vintage perspective.
I agree 100%. And just like you said, Craig, I mean, especially these next couple of years, there's going to be a lot of opportunities, and I'm excited for the years to come. It's bittersweet, right? You're going to see a lot of people, unfortunately, that got caught up with these bridge loans and are going to have to foreclose or hand these properties back over to the banks. But on the other side, that's where an operator like Lone Star Capital is going to be ready, to have all the resources in place to go out and get these deals, under contract. And I think, well, again, like Craig said, if you're an active investor or a passive investor, I think it's a great opportunity to get involved in and just take advantage of what's to come for sure. So yeah, thanks for touching on that, Craig. And um, I kind of want to shift over now and so what we call the fire round. We'll go ahead and kick it off here. So the first one is, could you recommend a book on real estate for investors just starting out, and another book that is particularly good for cultivating a positive mindset?
I would do Rich Dad Poor Dad would be the most important book that anyone could ever read. I think if you had to read one book, I would definitely do that. And then, although I don't really agree with everything associated regarding Around the Sky, I think 10X or Sell or Be Sold by Grant Cardone is actually a really great book. That's just from a mindset perspective. So I do recommend that. Not too keen on some of the other things that he does, but I can fully recommend that book from a mindset perspective.
Yeah, I'm with you. I like the guy overall, but there's some things that
The jury's still out on if I like him or not. I don't know if I can go
yeah,
that far, but I do
yeah,
like some of his messaging. I will say that.
yeah, exactly. I'm gonna say that Sell or Be Sold is a great book. I
Yeah.
mean, and it talks about you're selling yourself with anything you do or being sold to.
Everything in life is sales, which I can appreciate as a salesperson
Yeah.
whole life. So
Yeah. Well, I love the part in that book. Yeah, me too. And where he talks about, having to sell his wife on marrying him, right?
yeah.
Because I relate to that as well, man. It was a hard sell, but I was happy to close that deal for sure. And
Yeah, that's the most important deal you ever have to close.
yeah, absolutely, absolutely. All right, cool. So, what is a next question? What is a practical first step the audience can take to explore the space of passive investing?
Ooh, well, budget your lifestyle and your income, your P&L, because if you don't have the money to invest, you can't invest. So really figure out a way to make extra money so you can actually get your foot in the door. And, when you see, crazy COVID gains in 2020, 2021, 2022, early in the year, where you hear these people having just great pops and stuff, you can only take advantage of that if your money's in the market. So really audit your P&L and figure out your bottom line to, put your money in the market and get it to work for you as quickly as possible.
Yeah. No, yeah, I'm really glad you said that. And it's just that whole concept of pay yourself first, too, right? Before you go out and buy the fancy boats and the fancy cars or whatever, right? Man, it's pay yourself first and invest in your future. And make sure your personal finances are in order. Because if they're not, like I've had conversation with investors, it's you really don't really I turn people away because I just don't think it's the right fit for them to be placing their money with me when they're personal finances are a mess, or they're in debt, or things like that. So um, I think that's great that you touched on that, Craig, because it's super important. It really is. That's what's going to set you up for that financial success in the future, right? Third question here: what is a daily habit you practice keeping you on track toward your goals?
Getting back to everyone as quickly as possible via email to make sure everyone has their questions answered for our deals.
Yeah, I like that. And I appreciate that as well. And again, just another shout out to Craig and his team, with Dasha and everybody. They're super transparent and very responsive, which as a both the as a partner with you guys and a limited partner with you guys, right? I appreciate, for sure. So great answer. All right. And fourth and final question. If you could be remembered for one thing, what would that be?
Probably a nice person.
I like that. All right. Well, cool, Craig. Well, yeah, if you could, before we jump off here, tell listeners how they can find you, connect with you, learn more about you and Lone Star.
Yeah. Well, thank you so much once more for having me on the show. If you want to reach out to me, my email is Craig, CRAIG at lscre.com. If you're looking to invest or raise money for some of our opportunities to partner together, the more the merrier. Always looking to have the best and sturdiest bullpen of people and options there. If you're looking to learn more about the firm, you can go to our website, LSC at www.lscre.com. And then if you're looking for more educational information or listen to one of the shows that Rob and I do, we have two podcasts. It's the Capital Spotlight podcast. We have a weekly conversation with Rob, and sometimes we have guests on that show. Very rarely do we have guests, but then also finally Fun Friday, where I interview fund managers and capital raisers that we've partnered with to discover what they like to raise for, what they look for in these deals, and hear some of their projections and predictions as well.
Awesome. Well, thanks, Craig. And again, I just really encourage everyone to go to that website, and look at the content. Just again, they got a ton of information on there. Or if you're interested, go grab the books that Rob wrote. And Craig, again, thanks for joining us, and we'll talk soon, I'm sure. Oh,
Absolutely. Thank you so much. Looking forward to partnering with you, hopefully in another deal in 2024 and beyond.
absolutely. Thank you for listening to the Optimal Wealth Podcast. If you enjoyed this episode, please be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, be sure to optimize your results and take massive action on what you have learned here today. For more, visit optimalequitygroup.com.